Hi, and welcome to the Weekly Watch. I'm Brian Daingerfield, the co-head of G10 FX Strategy at NatWest Markets, filling in for John Briggs. The Federal Reserve hiked their key interest rate by 0.75% at their late July meeting and suggested that another unusually large rate hike could be merited. But the Fed also said that the pace of rate hikes could slow over time, with the decision on the pace of hikes to ultimately be driven by the economic data. Taming inflation is clearly the Fed's number one objective, and that means inflation readings are key to the Fed's path. Against that backdrop, the US CPI release on August 10th was the key risk event over the past week, and it came in softer than expected. Headline inflation was flat on the month, largely due to lower energy prices, including gasoline. While that weakness was anticipated, again, given lower fuel prices, the core CPI rate also decelerated with a gain of just 0.3% month over month, well below the consensus. The market reaction was swift and decisive. Markets came into the CPI seeing the balance for the September meeting loosely favoring another 75 basis point rate hike after recent strength in activity and labor market data. But market pricing shifted decisively lower in the aftermath of the CPI, and the markets now price the September decision as effectively a toss-up between a 50 basis point or 75 basis point hike. As Fed pricing ebbed, US front-end rates fell, driving a steeper US interest rate curve, while the dollar weakened broadly against the major G10 currencies. For US equities, the CPI reading was a positive from two channels. Lower inflation is not only a positive for US consumer and US consumer growth, but it also eases financial conditions by reducing the risk of ultra-aggressive Fed moves. The Nasdaq ended Wednesday's session, for example, over 20% off its 2022 lows, technically entering a bull market. But a slowdown in the pace of Fed tightening in September should not be locked in due to Wednesday's CPI release alone. A smaller 50 basis point rate increase in September was our base case prior to the inflation number, and it remains our base case today. But between now and the September meeting, the Fed will see an entire month of additional data, including business surveys, employment report, and another CPI. Those data could certainly shift the narrative back towards a larger move if the data come in on the stronger side, particularly on the inflation front. In CPI, for example, some of the softness in the latest core CPI was due to weakness in categories that may prove to be temporary, such as travel and transportation services, while inflation in stickier categories remained robust. The Fed is looking for clear evidence of slowing price pressures, not just one print. Looking ahead to next week, inflation prints outside the US are likely the highlights on the upcoming data calendar, with CPI in the UK, Euro area, and Japan all on deck. Retail sales in the US and UK are also due, and the minutes from the Fed's July meeting will be released as well. Thank you very much for listening to the Weekly Watch. If you enjoyed this podcast, please be sure to like and consider subscribing to our channel to receive additional NatWest Markets, economics, and market strategy content. Thank you.